So welcome back to Financial Accounting 1. And we're not in the Riverhead building. We're in my home office here in Stony Brook. And I'm joined by my friend, the Tribble. It's good to have a little support there. And what I want to do in this brief mini lecture is I want to go over the in-class exercises that we had done in class last Wednesday. I believe these were the exercises from Chapter 10. And I will do the same thing for the other two chapters that we'll be doing exercises in class 13 and 18. And the final exam, exam 3, will cover those same 3 chapters as well. And I'm going to make the final exam mostly exercises, and they will not be the same as the ones that we do in class, but they will be parallel and will deal with similar stuff. So it's always a good idea to watch and the little video lectures that I do for you, but it's probably especially good to do them and to review them if you want to do everything you can to do well on that third exam. So here goes. Let me share my screen here. So first one here had to do with what do we capitalize when we go and buy a piece of land? So one of the major topics in Chapter 10, accounting for property, plant, and equipment, and intangible assets and natural resources, is what actually becomes part of the cost of an asset. And we said the cost of an asset, whether it's a piece of land or it's a building or it's a piece of equipment, all those costs necessary to get the asset installed for the purpose I purchased it for. So anytime we buy something, whether it's a piece of land, whether it's a building, whether it's a piece of equipment, we have to ask ourselves what gets capitalized becomes part of the cost of the asset, and what doesn't get capitalized. If it doesn't get capitalized, it gets expensed. So let's take a look here. Farley Corporation purchased land adjacent to its plant to improve access for trucks making deliveries. Expenditures incurred in the purchase of land were as follows. So what we need to do is we need to look at all these costs here and ask ourselves, does that become part of the cost of the land? Remember, the land is cost is all those things necessary to get the asset installed for the purpose I purchased it for. And that's the lens within which we have to evaluate each of these expenditures. So purchase price, I would say yes. Broker's fee, yes. Title fee, $5,000, I would say yes. Demolition of the old building on the property, I would say yes. Grading, and what that means is that's getting rid of the hill that's on the property. Get the land for the purpose I purchased it for. So that I would include that. Digging foundation for the road, no, that's part of the cost of the road. Laying and paving the driveway, nope. Lighting, nope. Signs, nope. These are not part of their costs that are being incurred, but these are other costs. These are in the form of improvements. These are not actually part of the cost of the land. So anytime you go and purchase lands, or any other asset, you got to list all the things available, what becomes part of the cost. So the answer here is the purchase price, the broker's fees, the title, the demolition, the grading, and the land acquisition. Total land acquisition cost is made up of all of those things. Those other things is not that they're not important. Digging the foundation for the road, laying the driveway, lighting, signs, those are all other assets that will be capitalized separately. Could have some things that would be expensed as well. We don't have those in this particular problem. So that's exercise 1. Exercise 2, this is the method by which we recover the cost of a fixed asset or property, plant, and equipment. We recognize the cost of the asset over its useful life through a process called depreciation. So depreciation is the systematic and rational way of taking the cost of the asset and spreading it over its useful life. Now, depending upon what method you use, you're going to get different answers. So we have straight line, we have declining balance, we also have units of production. In this particular exercise, we're just asked to compute depreciation for the first 2 years under the straight line method and under the declining balance method. So like we saw with inventory, your choice of inventory gave you a different answer. Your choice of a depreciation method will give you a different answer as well. So key things, we made it nice and simple. We told you what we paid for the machine. We told you that it was expected to have a $5,000 salvage value. which means at the end of the life, that's what we think the thing is going to be worth. And we're going to spread those costs over a 5-year period. So now we've got the information we need to compute the depreciation on the straight line basis and a declining balance basis. So straight line basis, the reason it's called straight line, if you graphed it out and you put, each year what the depreciation expense would be, it would literally be a straight line because the depreciation expense would be the same each year. So what we simply do is we take the cost of the asset, which is 80, we subtract out the salvage value, and we divide by 5. So 80,000 divided by 5 is 75,000. Divide that by 5, you get $15,000 a year. So that would be the depreciation the first year, second year, third year, fourth year, and fifth year. It would be the same, i.e., it would be a straight line. Double declining balance, however, is going to give you a different answer. If you look down in the formula here, double declining balance is cost minus accumulated depreciation times 1 divided by the useful life multiplied by 2. So it's twice the straight line rate. So the first year, you don't take into consideration in the calculation salvage value, but what you need to remember is you cannot depreciate the asset below its salvage value. So if we had gone into year 4 and 5, eventually what would happen is we would have a salvage value. We'd approach a salvage book value of $5,000. Book value defined as cost minus accumulated depreciation. So we'd stop at 5,000. But as far as the actual computation, it's called double declining balance because it's twice the straight line rate. If you take 1 and divide by 5, you would get 20% a year. So twice the straight line rate would be 40%. And it's declining balance in that you take the full cost of the asset, not considering depreciation, not considering its salvage value. So 80,000 minus 0, because we base it on the book value and there is no depreciation at the beginning of the year. So 80,000 minus 0 times 40% gives you 32,000. So that's your depreciation the first year. Second year, and this is why we call it double declining balance. So we use double the rate rather than using 20%, we use 40%. And we call it declining balance because notice what happens, beginning of the 6th year, the book value is $80,000 minus the $32,000 worth of depreciation we took the first year times 40%, and that gives you 19,200. So you'll see here when you contrast the two methods that the double declining balance gives you the, in this particular case, the majority of the depreciation actually is in the first year and the second year. So what will happen is each year this number will go down, but we will look at just between the first 2 years, we've got $41,000 worth of depreciation, whereas under the other method, we only had $30,000 worth of depreciation. So declining balance puts most of the depreciation in the early years. All right, so that's straight line, that's declining balance. Number 3, here we have to recognize gain or loss on a disposal of equipment. Disposal is just a simple word for getting rid of. So we have to ask ourselves, when we dispose of an asset, is it disposed at a gain or is it disposed at a loss? So in order to answer that question, we have to compare the proceeds to what the book value was of the asset. And if the proceeds are more than the book value, we have a gain. And if the proceeds are less than the book value, we have a loss. So we sold equipment for $10,000, so that's the proceeds. The equipment had a cost of $48,000, and the accumulated depreciation was $40,000. So right away, we know the book value of $48,000 minus $40,000, we got a book value of $8,000. And we received $10,000, so the proceeds exceed the book value by $2,000, so we know we have a gain. So whenever you have to dispose of an asset, you always are going to debit cash for the amount of cash that is going to be received. You're going to debit accumulated depreciation for the depreciation that was taken in earlier periods, which in this case was $40,000, and you're going to have to credit the equipment at its full original cost. The difference is always going to be a gain or a loss. So in this particular case, since the proceeds exceeded the book value by $2,000, we have a $2,000 loss, $2,000 gain rather. Okay. If the proceeds had been less than the book value, then we would have had a debit to the loss account. So this could be a gain on the sale of equipment or disposal of equipment. You could have a loss. So you have to compare the amount that was received, called the proceeds, to the actual book value. Right. So in this case, the proceeds exceeded the book value by $2,000. which is why we have a gain. So I know some of you are still struggling with journal entries. You will be expected not only to come up with the gain or loss, but you need to do the related journal entry as well. And the last one, we're going to do a whole chapter on financial statement analysis, but since we're in chapter 10, we want to focus on a ratio that shows how effectively the company is using its assets to generate revenues. So what you do is you take the beginning assets and the ending assets, that'll give you the average assets. You relate the average assets, that net income is just put there to confuse you. You take the net sales that you had for the period and divide by the average total assets. So net sales were $2,500,000. The average of $800,000 plus $1,200,000. If you get those, actually, that's an average of $1 million. So you had an asset turnover of $2.5 or 2.5 times. That means for every dollar we had invested in assets, we were able to generate $2.5 in revenues. Now, be careful with these ratios. You got to be able to compute these ratios, and you got to be able to answer the question, is that a good ratio or a bad ratio? And the answer is, I don't know. You can only tell that if you've got something to compare it to. So what was the asset turnover for this company in previous years? Was it more or less than 2.5? What is the asset turnover for my competitor? Is it more or less than 2.5? Now, what did I wanted it to be? So you always have to have some basis of comparison to get the true meaning. All we can say here is that for each asset dollar we have invested in assets, we were able to generate $2.5 in sales. All right. So I hope you found that little review useful. And as I said, I'll do one similar on the homework for the remaining 2 chapters as well. Okay. The exam questions will not be the same, but they'll be similar in terms of their focus and content. All right. Be well, everybody. Look forward to seeing you on Wednesday. Be well. Have a good evening and a good week, rest of the week. Until we meet again. Adios. Hasta luego. Au revoir.